Welcome to the Investing Podcast presented by Tusk Media. This is Outsider Trading, an audio and video deep dive into the people, places, and things that we find most interesting in the market.
Hey everybody, welcome back to the Investing Podcast presented by Tusk Media. Real quick, do us a favor, check us out on Twitter, Facebook, YouTube, all of those places we are at Tusk Media LLC. So youtube.com/Tusk Media LLC. For instance, you can check out this video as well as all the others. If you're watching this video, I don't know why you would check it out again, but you can still do that. I am Andrew Hall. Joining me today is Ben Nye. Ben, what's up, man?
Not much. A wet day today in Marietta, Georgia.
Very wet. It's kind of been raining all off and on for the last couple of days. Some tornado threats, not necessarily in our area, but around the state, so everybody stay safe out there. Today we are talking about Valvoline, ticker VVV. Kind of I guess I'd call it a new old company. A company that's been around for quite a while, but is publicly traded by itself for the first time fairly recently.
Yeah, it's been in a number of different entities. It's been owned by private equity, it's been by itself, it's been owned by, most recently by Ashland, the chemicals company. But last year they had an activist in there and they ended up spinning off Valvoline to existing Ashland shareholders. It was a little bit of a complicated spin-off because it didn't happen immediately. What happened was they actually IPO'd Valvoline and they kept about 80-85% of the stock. So only a little bit of the shares were outstanding from September onwards. Then beginning of May, they spun out the rest of the Valvoline shares. Ashland spun out the rest of the Valvoline shares to Ashland shareholders. And so now Valvoline is a distinct separate entity.
So basically took a small chunk and said, hey, let's get this thing out, almost as a transition period.
Right.
And then, in order to not totally blindside shareholders of Ashland, they were able to say, hey, this is already publicly traded.
Right.
Here's your spinoff. Do what you want with it.
Yeah. So what did they actually spin off? Well, we all know Valvoline. They come out with the motor oil, and that's certainly part of their business. They have a core North America business, which includes selling that to do-it-yourself shops like O'Reilly and Walmart. You buy the motor oil there and then just change your own oil. They sell it to independent do-it-for-me shops like Goodyear and other service outlets like that. And they also have a commercial industrial business selling it to more fleets. So that's about 50% of their business. Another 25% of the business is also located in North America, and that is the Quick Lubes. And this is their wholly owned or franchise locations where they're actually performing the oil changes. So they also made an acquisition of Oil Can Henry's. They own a number of locations, over 1,000 locations, either franchised or owned in the United States, about 400, I think, owned, about 700 franchises. And that's about 24% of the business. What they're doing in that part, that's their fastest growing. It's higher margin, it's faster growing, and what they're doing is something that's pretty clever. They're actually buying a lot of their franchises, and so they're keeping more of that profit for themselves, and they find that they're actually operating at a better level in their franchises. So that's about 25% of the business. That's what people look to the extent that they want Valvoline to perform well and
so
outpace the growth.
When you talk about that growth, where do they stand currently in that segment among competitors? It seems just as a consumer, like I drive by 1,000 different of these. How are they positioned within the market?
And so they're the second biggest player, but it's a very fragmented industry, as anyone who drives a car knows. So the number one player is Jiffy Lube. They have about 1,900 locations. I think there's about 11,000 locations in the United States to have a service.
So even the leader is only about 20%.
Exactly. And they're trying to consolidate more of that, obtain more market share, but I think the pricing power ultimately comes from how well do you actually position, how strategically do you think about and tactically about positioning your service location in a well-trafficked area where you can actually get that premium customer. So that's a big piece of that business. And then the last piece that we don't really have to touch on too much, it's lower margin, it's international. And this basically, they say, you know, we're making this motor oil anyway, so we might as well just sell it to distributors in Europe especially, and then they do it there. So that's definitely a smaller piece of the company, but it's something that if all of a sudden Europe just explodes in terms of growth, then you know they have some exposure there. But really looking for the Quick Lubes business to really take more of that business, grows a share of the business over time, as the core North American motor oil sales is kind of muddle along.
Yeah. So when we were looking at this company, it was kind of unique on a couple fronts. Obviously, the most obvious, that's again relatively recently IPO'd, spun off stock. People continuing to kind of accumulate those shares and decide what they want to do with it, which I would think creates a little bit of market inefficiency,
right,
to some regard, and you know then creates the question really of value. But one of the things we came across, really while you were doing your research, is kind of a unique pension situation.
Right.
So talk a little bit about what's going on there.
Yeah. So you know, Valvoline will show up on a lot of screens because it has a low price to earnings, lower enterprise value to EBITDA, a lower and a reasonable enterprise value to sales. But you say, well, okay, why is the price to earnings and enterprise value to EBITDA so large and the enterprise value to sales discrepancy relatively small? You'd expect Valvoline to trade at a discount because they do have the Ashland shares out there. But why is it so much of a discount? And what you see is that there's actually a big piece of that is actually pension income. Now, what happened was when Ashland spun off Valvoline, they also attached these pension assets. Now, pension assets are mostly unrelated to Valvoline, but what Ashland wanted to do is they wanted to get this underfunded pension off the books and just shove them into Valvoline, which is perceived as a strong brand, relatively stable company, and so get those pension assets off Ashland and shove them to Valvoline. So Valvoline is now dealing with this. They sold a small portion, relatively speaking, it was about $300 million last fall in connection with the spinoff. But that was matched, about $300 million assets, $300 million liabilities. What happens is now they have about $900 million underfunded liability. But what happens is because of the return assumptions and because of the discount rate on the liabilities, they're actually generating pension income even though the pension is underfunded. So about 20 cents per share about after tax is a pension income. So instead of about $1.40 a share, I think guidance is $1.37 to $1.43. Instead of that amount, you're talking more like 120, high 1-teens in terms of earnings power. And you plug that into your models, and all of a sudden the valuation discrepancy doesn't look as large. I think there's a case you can make for an investment in Valvoline, but it's not on a relatively basis as cheap as it seemed at first glance.
So what's the longer term plan on the pension? What do you think their play is there? Is that something that's just going to kind of ride along there and something we continue to work around on our modeling, or is that something that has any kind of exit?
First of all, I think that even though they say that they need to report it because it's a significant and recurring amount, I think they should also be upfront and say, this is the cash flow that we're expecting. The pension income, that's not a cash flow, and so I think they just need to have more clarity around that. And I think to some extent they have, but this is again relatively new management team. They're kind of working out the pension themselves. Quite frankly,
they got straddled.
It's not their fault. So they're working through that. Going forward, I think that what they want to do is more transactions like we saw in the fall. Problem is that even though it's throwing off this pension income on an accounting basis, it's not, an insurance company who would come in and buy it wants the pension to be fully funded, and that's not the case right now. So they're running into some issues with that. I think the pension income and the pensions gets offloaded. I think that actually takes an overhang off of the stock, because although earnings will go down, I really don't think that people should be counting on the pension because it's not a cash flow. If you value a company based on the present value of the cash flows, and first of all, if you have an underfunded pension, by implication, the cash flows are negative.
The win column.
Exactly. So, it's a good company. I think they're doing some of the right things. They're passing through a lot of oil prices to the customer better than they have in the past. In 2011, they made some changes with those policies, so I like that. I think the brand is strong, and people love brands in this day and age, especially on the private equity side and the activist side. So you have that going for you, which is nice, but you got that pension overhang.
What other trends do you see kind of on a somewhat macro level that could benefit Valvoline? And the thing that comes to mind immediately for me is really synthetic motor oil and
right.
The difference there. Does that benefit Valvoline? As more and more cars move towards synthetic, is that a positive thing?
That's a really good question. That's something we've been trying to handicap. So Valvoline definitely looks at it as a positive, primarily because they have 50% premium on the pricing. If you do a quick price check, I did one at AutoZone, for instance. A 1 quart bottle of conventional gasoline oil will cost you $6.29. The synthetic power, both provided by Valvoline, will cost you $9.49. So that's a 50% premium. Now people say, well, you can change your oil twice, half as frequently if you use synthetic oil. But I think that a lot of people still in their minds have hardwired that, it's 3 months, 3 months, 3 months, 3,000 miles, 3,000 miles. So I don't think you're going to see a massive shift to an elongation in terms of how frequently people change their oil. In fact, over the last 5 years, it's averaged about 1% a year in terms of increasing length of time. In that same space, the proportion of synthetic oil has gone from 27% to 51%. So you're seeing much faster growth there than you are in the length of time between the oil changes. The last piece is you will want to see an increase in miles driven because that will, you just need to change your oil more frequently. We are seeing that as the economy has improved. And you also want to see relatively low oil prices. Firstly, that means lower input costs for Valvoline. Secondly, it means that lower oil prices, everything else being equal, means lower gasoline prices, which means people are more likely to drive.
So yeah, that's kind of almost a whipsaw effect.
Yeah.
In the sense that not only is more being used, but they're also getting it a little bit cheaper.
Exactly.
Getting there. So there you go. Valvoline, ticker VVV. We do not own it. I don't think we own it.
No, we're waiting on it. We're
waiting a little while. Going to be patient, and I do think it's a stock where you're going to see opportunities again as those, kind of inheriting shareholders look at their portfolio and say, hey, why do I have this?
Yep.
That's going to be there. Other side is just potentially as pension assets are sold off, some people could misconstrue what earnings actually are, and earnings could take a perceived dip.
Yeah.
Even though it may be a good thing or just a neutral thing, and the stock could suffer a little bit. So.
Indeed.
Couple catalysts kind of on the horizon just to keep an eye out on, and we'll definitely be watching them and update you as we see things that need to be updated. Y'all have a great day. We will talk to you soon.
Tusk Media is a subsidiary of Narwhal Capital Management. Ratings and reviews of Tusk Media content are not to be construed as endorsements of opinions, analysis, or services offered by Tusk or its parent company. The opinions and predictions shared here are our professional beliefs at the time of publication. We are not under duress from any of the corporate entities mentioned. This is not a solicitation to take any particular action. Although we are investment advisors, this information should not be considered investment, legal, or tax advice. We strive to be as impartial, insightful, and accurate as possible. We base our opinions, analysis, and calculations on information we believe to be reliable, but we cannot guarantee its accuracy. We can, however, guarantee that our opinions will sometimes be flat out wrong due to a variety of factors. Employees and clients of Narwhal Capital Management may or may not hold positions in the securities detailed and may or may not hold these positions in the future. A full list of all securities purchased, sold, or held during the 12 months preceding the date of this publication can be provided upon request. Unless otherwise noted, all data accessed via MarketWatch or the Bloomberg terminal. Past performance does not guarantee future results. A copy of Narwhal's Form ADV is available at the SEC's website, www.advisorinfo.sec.gov, or from Narwhal upon written request.